All right, guys. So today I'm going to walk you guys through how to build an operating model, financial modeling, just kind of the pure basics. And this is in the last video. Check it out if you haven't seen it. I went over my research process, how I go through a qualitative aspect of the research process, and then that funnels its way into the financial modeling, and the financial modeling leads into the valuation for the business I'm looking at. You have to have an understanding of all those qualitative factors about the business first. The competitive landscape. Is there going to be margin compression due to competitors coming in offering the same service cheaper, et cetera? But today we're going to go over a company called Gaia. They're a niche streaming service and like a online yoga streaming service as well. And it's a completely recurring revenue subscription model. So it's pretty easy to forecast, and their operating expenses are pretty fixed, and they give pretty clear guidance. So I'm just going to run us through how we're going to just forecast the income statement out from 2023. So if you look here, I have historically, I just added into 2017, 2018, 2019, 2020, just so I can compare, look at, because these numbers kind of tell the story of the business of the past, right? And you can compare that with the chart and see how the business performed during this. And you can see that they were losing a lot of money through until 2020. And during this period of time, the business was just going through a hyper growth point where they were just trying to get as many members as they possibly could. And then in like end of 2018, maybe 2019, they said they're going to start working there on a path towards profitability. And they eventually achieved profitability here in 2020. And now my assumptions are that this business is going to be a cash cow. They're going to start producing a lot of cash flow. But today we're just going to focus on modeling the income statement using scenario analysis here, working through a best case, base case, and worst case to kind of come up with some different outcomes. And there's one thing you do when you're forecasting, you know that your expectations aren't going to be 100% correct. There's going to be changes, especially when you're going as far as 2 years out. Even if you're doing a 5-year DCF model, you know you're going to be wrong. What I like about modeling, it allows you to take your implicit assumptions and make them explicit, and it really makes you know what you're talking about. Kind of like when you, if you guys write, if you journal, you really know what you're talking about when you can write it out. And if you don't know what you're talking about, you realize how much you don't know when you go to write it out. So that's kind of what the exercise is for me. I don't weigh everything for my investment process into the model, but it is a key integral part for me. So here we can look up, I have the historicals added in. I don't have the little things in here like other income, taxes, etc. I do have it in here historically, but we're just going to skip out on that for the time being. You should just note that this company has 194 million in net operating loss carry forward, so this company won't be paying taxes for a very long time. Okay, so now we're going to start out modeling 2021. And first, we have to, how do we get a base? How do we know, how do we figure what this company's going to continue growing revenue at? We're not just going to throw a dart, right? So all we have to do is I use this website called Unhedged, where you can highlight and save highlights in the filings or the conference calls. But here's the company's most recent earnings transcript. It is the Q1 2021 earnings call. So here I highlighted in blue some of the key things we need to know when we are building this model. So let's see. We continue to execute against our plan of consistently growing revenue while generating positive net income and cash flow. We crossed the 750,000 member milestone, and revenue for the quarter increased 30% to 18.9 million. So they're growing at 30% year over year already in Q1. Their gross margin increased to 87.1%. Now let's look back historically. What's that gross margin been? It's been right around the 86, 87% mark. So what I'm already going to do is I'm going to go into my scenario analysis here. I'm going to make a worst case scenario. They haven't been below 86% in a long time, but let's say they run into more costs upcoming, and we'll just say that'll be 85% across the board. 86% will be our base case, and the highest they've been has been 87%. So we'll keep those at 87% there. Now I got to do some formatting because that'll bother me. No border, thick border. Okay, so look at that. We've already built our best case, base case, and worst case scenario for the gross margin. And here, this connects up here. So when I drop down this tab here to go to base case, you can see that changes to 86% and it lines up across the board. And all Augury Pro subscribers have access to my model. And if you don't have the model, it is downloadable on the investor toolkit on the membership page of the website. So we got our gross margin lined up. Let's go back here to the conference call. So, which keeps us on pace for our target revenue growth of 20+% for the year while maintaining profitability and cash flows. Okay, so we know they're looking at revenues being above 20% in a best case scenario here. Let's keep going down. Here's our EBITDA run rate. If we were looking for that, we're not necessarily looking for that right now for this exercise. Here, an analyst is talking about you've reiterated your 20% growth objective for this year. Here's what the CFO has to say, but I will say is we are focusing on staying net income positive and generating cash flows, but not being happy with future years revenue growth of only 20%. So we know in 2022, they're going to want to grow above 20%. So we're going to assume in 21%, or in 2021, they're going to be above 20% as well, probably say towards 25% in a base case. And they're going to start investing, as they mentioned, in certain specific growth areas. And they're expecting that operating expenses continue to rise higher as a number, but decrease as a percentage of revenues. And I'll show you what that looks like here. So here's their selling and operating expense. And here it's been declining. But if we're going to have 20% revenue growth, the revenue is going to grow a lot faster than the expenses will. So the expenses can still grow to 60 million, but because revenues are growing at 20%, and that's not a 20% growth to get to 60 million here, it'll be rising in dollar amount, but the overall percentage of revenues that operating expense will be declining moving forward. So let's come back in here. That being said, we're still confident in our ability to drive 20% revenue growth for the year while maintaining positive net income and cash flow. And that looks like all the information we need. Our primary focus is going to be on growth capital and driving incremental growth above 20%, not necessarily by spending more on marketing, but by spending more on these other initiatives, member-driven growth and professional ambassador groups, the international expansion into French, German, and potentially other language as we look out into future years. Okay, so this one's pretty easy to get a grasp on the basics. And then we're just going to go through and you'll do your first run through when you build a model. And generally you'll have 2, 3, 4, 5 run throughs. You'll keep running through it. You'll keep updating as more information comes available as quarters go on, and they'll slowly become more accurate. Usually you do your first run through, then you come in and refine it after that. So today we're just going to do a first run through. So for 2021, they talked about being above 20% growth. So let's say in our best case, we're looking at, they did 30% year over year in quarter one. We'll give them 27%. Base case, let's give them 22%. They have very good visibility into growth for 2021 as being a completely recurring subscription model. So worst case, we're going to make 20% flat. Then they're not going to be satisfied with the growth moving forward in 2022 at only 20%. So they're going to keep it mid-20s and push towards 30 there. So let's give them a best case of 25% in 2022. A base case, say something, let's say they just land more 2021. They can't quite get the growth that they're looking for, or else they're not willing to spend that much money to get the growth because they're focused on staying profitable. Worst case, we'll give them 17% revenue growth. And your worst case usually should be pretty far off of even your base case, because if you can model something and you see that you still have a margin of safety in your valuation, while your worst case is still pretty bad, like you really think it's improbable that they're going to hit the worst case. So you want the base case to be the most probable, and best case a little bit above that, to kind of give you just a range of different outcomes. For 2023, let's say growth starts slowing as they've already made more penetration in international markets. And generally, this is something that you'll see how people model, how sell-side analysts model, is that people tend to have growth decelerating into the future, just because they're discounting their ability to predict the future, which they should. But sometimes in models, you get caught up and you don't realize how right you can be, or how right the company or how good the management team can be at reinvesting that capital. So that's why you're constantly looking and refining the model and changing assumptions, attempting to make them more accurate. So let's say they can only go 20% in 2023. Let's give them 17% base case, and worst case, let's do 14%. So we already got our revenue growth and our gross margin. We're just going to do the OpEx manually for this exercise here. So now let's just connect our revenue. So 2021, the percent growth needs to just be connected back to the scenario analysis. So 22% across the board. Now the gross margin needs to be connected to the scenario analysis. 86% because we're looking at our base case here. Okay, so now we'll do equals 2020 revenue times 22%, and we'll add back the 2020 revenue to get a 22% growth rate. Then we can just copy that right over into revenues out to 2023. So we're looking at 115 million in revenue for this company in 2023 in our base case. So now we'll just take our revenue times 86%, the gross margin we have in our base case, bring that across the board. So we're looking at, let's reformat all these numbers so there's a comma there. 2023, you're looking at nearly 100 million in gross profit. I think this company's market cap is around 240 million right now. So I guess they're trading at around 2.4 times their gross profit. Now, to the operating expenses, the hardest part to predict because there's little changes. They said they're going to be increasing overhead. If you do some investigative work and go to their LinkedIn, you can actually see how many jobs that they have out there they're hiring for right now. And that's a pro tip when you're researching companies. You can get some really good information of looking at the positions they're hiring for and reading the job description to see what the company is working on. Big pro tip. Definitely recommend adding that into your arsenal. That's helped to make me a decent amount of money and improve my returns over the past couple of years. So they're expecting to have this increase in dollar value, but decrease as a percentage of revenue. So let's see what this is as a percentage of revenue here. 72%. So it's decreasing, but they've increased by about 2 million. And remember, I'm not saying any of this will be accurate at all. Let's keep the corporate G&A steady, probably about 7% of revenues. We'll take 7% across the board here. 7%. So equals this times 7%. Take it over. So you can see this is increasing as a dollar amount as they bring on more heads and overall employee head count, but staying the same on a percentage of revenue basis. So let's say in 2022, they're probably going to have to market a little bit harder, even though they said they don't want to spend directly on marketing. They're building these ambassador programs that work through YouTube, et cetera, and they're moving into international markets. And I remember, because I've studied this company, I've been following them since like 2018 or so. They had might be a little too much information, but I'll throw it out there anyways. They had an ambassador who recruited 240 members alone by himself to become Gaia members. So they're going to, and he wasn't a YouTuber or anything. He was just a normal person, but they're going to be attacking YouTubers who have similar content to them. And so on. I guess we'll get some more information about that looking forward. But if you're interested in more, you can go to their LinkedIn and read some of their job descriptions they have out there right now. So let's say they have to spend a little bit harder here. 4 million, which 4 million goes a very, very long way for Gaia if you just look back historically here. So this will be, they could increase their selling and operating spend by 4 million and it still decreases to 64% of revenues. Now let's say they increase another 3 million here, 66,000. Another 3 million ad spend, but only 57% of revenues. So right now in our base case, we're looking at 0.75 EPS, assuming share count keeps climbing. And they don't buy back any shares because they do have a buyback in place. See, there's a lot of working parts that you need to know about going into this, and know that you are inaccurate, but you're doing the best you possibly can. And it's just helping you understand the drivers of the business. And you can see if they just, what 1 million less dollars does here to the EPS, takes it up 5 cents. So you can see the sensitivity of that moving forward, and how it reflects in the profitability of the business. So now we're looking at a 1 year forward PE ratio in our base case of current share price is $11 divided by 0.75. So you're looking at a 14 PE here on a 1 year forward basis. How about a 2 year basis? On a 2 year basis, you're paying about 9 times earnings on a 2 year basis in your best case scenario. So now let's change to our worst case scenario. Worst case scenario, we're looking at 80 cents in EPS in 2023, which would be a 13 PE. And right now you would be paying a 1 year forward PE of 21, which, like we went over, we think that the forward, the worst case scenario is very improbable, that they did 30% year over year growth in Q1, and they expect to be 20+%. Our worst case is 20%. We really think that should be in a 23 to 27% range. But again, this is a worst case scenario. And then 2022, they said they wouldn't be satisfied with only 20% revenue growth, but we gave them 17% in case they overshoot a little bit. But if you historically research this company, they're dead on, they're dead accurate with their guidance. But it just helps us understand what we could lose or where the business could end up if a couple things went wrong here. So yeah, that's the 1 year forward PE and 2 year forward PE. And now let's take a look at our best case. This is when you're really right. You would be paying 11. You're paying 11 PE for 2021 earnings, and only 6.94 PE for 2023 earnings on a business that's growing 20% with an 85% gross margin. Except I think we went wrong here. I don't think I did it right. No, we're good. Yep. So that's the basics of financial modeling. And this is all the more complex that my models get, or your models need to get. Just gives you a base understanding. And generally, if the idea is good enough, as you're just building out the income statement, you already know if it's an attractive idea. You should already know if you're getting to this point in your research process. Again, go back to that video that I created on my research process. And the first things that I go through is qualitative aspects of the business. You have to know all the qualitative aspects of the business before you move on to modeling, before you move on to the valuation of the business. Without understanding those qualitative factors and what makes the business unique, what are competitive advantages, how they tend to expand market share, grow revenues, then understanding the operating leverage that this business can produce. You have to do all of that first before you can get into this modeling. So I'm going to end it here, and I will continue on. There will be more videos throughout these lessons. So thank you guys for tuning in, and I hope this helps someone out there.